What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked number one on Wall Street in the 2024 All-America Institutional Research Survey. In this week's episode, we'll be discussing Wall Street Strategist S&P 500 price targets. Once again, I'll be speaking with Stephen Gregory, my long-term colleague, who heads up the quantitative research effort at Piper Sandler. Hey, Stephen.
Let's talk about targets.
Let's talk about price targets. That time of year.
We just got done doing our outlook 2 weeks ago, and we did a episode last week on outlooks. Big part of outlooks, market targets. In looking into this episode and kind of wanting to talk about this, because it's an important part of what people associate with portfolio strategists, we found, and I think it was pretty interesting, that targets go back to the 80s. And then I think is really interesting because I don't think a lot of people know this. The S&P 500, as most people think about it, didn't begin until the 80s. Like, it was really just an industrials index before that, which didn't get into financials until even the late 70s. So the fact that targets started then makes a lot of sense, but that could be an entire episode. Let's talk about price targets. They're really hard to do. What does it take to put a price target together?
Sure. Well, price targets are done, I think, simply to communicate in a shorthand form whether one is bullish or bearish. And our clients use that, I think, as an input to inform their portfolio positioning for the year ahead. And it breaks down to obviously earnings and the multiple, which you want to put on that. Both are, as we will discuss in today's episode, have a multitude of variables that one has to think about and consider to come up with a price target.
Not easy.
No, it's not easy. There's a lot of articles out this time of year, and in this year, particularly in 2025, that are highlighting the past 2 years, how the S&P 500 has had these 2 great years of over 20% gains. And when you look back at the consensus strategist targets, in both years, they were way too low. And we looked back at a long history of this, and what we found was that usually strategists are either too bullish or too bearish, not necessarily as a function of their earnings outlook, but more because the market multiple went up or down a lot in a given year. And so the last 2 years, obviously, we've had market multiples that went up a lot in both years, in fact, contributed or explained the bulk of the gains. And that is often where you tend to see price targets. And I would say this is probably true for fundamental analysts too, that are either too bullish or too bearish. And so that, I think giving some context to that, I think is important because this is nothing new. When we looked back into the beginning of price target history back in the 80s and 90s, a period that started off with the S&P 500 PE in the single digits. And during the 80s and 90s, we had basically 2 decades of falling interest rates and rising multiples. What you saw were generally strategists were too conservative in their price targets. And of course, that changed by the late 90s.
Underestimating that really came down to not getting the PE right and being too conservative in a rising multiple environment. I imagine that changed dramatically, as I'm sure isn't a big leap post the dot-com bubble.
Yeah, well, after underestimating price targets for many, many years and all the enthusiasm that came around the tech bubble, we started seeing strategists overestimate price targets and justifying really, really high PEs. And of course, all of that ended with the 2000 market crash. So it was followed by a period after 2000 where investors were quite gun shy with high PE stocks.
So valuation sensitive. Whether you want to talk about individual companies, aggregate strategists, investors, everybody was focused on valuation post the dot-com bubble.
Absolutely. Well, here's a fun fact. The term GARP became popularized as a result of the 2000 market crash, which was obviously mostly growth stocks, as growth managers were having difficulty attracting new capital because, of course, of what had happened in the prior 2 years. So this idea and popularity of growth at a reasonable price was really, I don't know if it was born then, but it was really popularized, certainly as a marketing effort.
Major market events tend to have behavioral implications for the market, whether that's being more valuation sensitive, more concerned about balance sheets. There's always this like follow through in markets that shapes the landscape for potentially decades to come.
Yeah, so then we had the great financial crisis in '08 and '09. You had a big impact on investors, and that really, changed the earnings, strength. And, that was a period where we had very slow and weak global growth, and for a period of time there, investors also, if you look through the whole decade in the 2010s when we had zero interest rates, we also did have many periods where, again, strategists underestimated market returns because multiples beginning in 2011 started going up and really went up for the next decade. So once again, you saw that same underestimation of the market target because earnings were growing and doing what they were doing, but multiples were going up and up, and giving these really fantastic returns during that period. So when we think about where we are now, we've seen a lot of market volatility since COVID. 2022, of course, was a period where most strategists overestimated the market. Of course, we had a huge PE shock. And then in 23 and 24, the last 2 years, again, if you look at the starting point of consensus, it was also too conservative. And again, both of those years, it wasn't that earnings exploded to the upside necessarily for the index. They were strong, and obviously Mag 7 carried that, but the broader multiple went up for in both those years. So it brings us to today.
All right. It's got to be so difficult to put a target together these days with index composition being at such extremes in terms of like capitalization.
Yeah, there's so many challenges and things to consider for the overall indices. And one thing that always makes me chuckle is that why do strategists do a year-end price target when every other fundamental analyst on the street covering companies are always giving 12-month rolling targets? So I always thought that was interesting because, you have to figure out where the market's going to be at literally December 31st at the end of the year. And that, of course, that's why you see strategists change their targets throughout the year, even as late as November, which, of course, as your end of year gets closer and closer, forecasting it presumably is a little easier and maybe also a little less relevant. But, I have seen some strategists do a more of a rolling price target and basically break the mold of this end of year arbitrary calendar backdrop.
That's interesting. I've never seen that. I don't pay that close attention to it. We have what we do in this business is actually a little different than that. I wonder if it's a little chicken or the egg. Do strategists love doing targets and want to have this rolling 12-month thing where you're kind of always adjusting and adjusting? Or is it like, I want to set it and forget it at the end of the year and then, just tweak at the edges?
Yeah, well, I think by having a year-end target, it creates this anxiety, especially in the beginning of the year, because when you're giving a price target for December 31st, and let's say the month of January, the market, let's say you're bullish and the market's down a lot, you feel like you're wrong. And, kind of investors that, despite what everyone says, are often very short-term focused, treat you like you're wrong, despite, still 11 months left in the year. So it does create this behavioral anxiety. And
Nothing moves in a straight line, and there's a lot of volatility. I can imagine, even if you got it right every single year, you're going to look wrong a lot of days. We're so short-term focused. We're looking at the markets. It's what we do every day.
so let's dig into these two variables, earnings and multiples. So Stephen, we were talking earlier when we were preparing for the show about, with regards to earnings, how strategists typically forecast earnings and therefore plug that into a price target, and what the challenges we face in doing so across history, across time.
When you look at earnings, index composition is where you got to start, especially today where you have the Mag 7 and they make up such a large portion of the index. But it's such a difficult thing to do because while you have their, stocks weight contributions, their earnings contributions can be very different. It's just a very difficult kind of thing to estimate. You have exposure from other countries you got to take into effect. So you're kind of making market calls on other countries. Not only Does the market change over time in terms of the competition? So it makes it difficult to look back in different periods that were similar environments. You have S&P at least once a year changing constituents. So you could be right about the constituents today and where their earnings are going to be and be 100% right. But then it took a couple companies out, put some companies in, which luckily most people only do S&P 500 earnings and price targets. Because could you imagine if you had to do 400 ones where they took all your winners away every year when they did their
Yeah.
rebalance?
Yeah. Or the small cap index.
Or small cap, where you have, Russell's the extreme example where I think it's something like over 40, almost 50% of companies have no earnings. Even the 600's 31% last time I looked. Companies have no earnings. So a portion of your index, you're kind of just detracting from you. And then you took the winners away, it would be nearly impossible. But earnings are a very difficult thing because there's a lot of little moving parts. There's 500 of them.
Not only that, but your points about the composition changing. So the sector composition changes. We have today obviously a lot of TMT in the market, but also even regardless of the sector composition, the fundamental composition of the companies within the index can change. In the 2000s, there was a massive growth in revenue derived overseas when China
Mhm.
was booming and the emerging markets were booming. So why all that's relevant is because when you think about how strategists or even economists forecast earnings, they're doing it using often macro regressions. So plugging in where the dollar is, where they think GDP growth is going to be, where interest rates are. And those are all important variables, of course, for the economy, but the relationship between those variables and the S&P 500, as you and I both know all too well, can dramatically change depending on what is in the S&P 500. So for example, if we, took today's S&P 500, which is massively overweight growth stocks and AI stocks, et cetera, and tried to regress what the fair value should be using a time series analysis that included the period of, let's say, 2006, where financials, industrials, energy, and materials were the dominant part of the S&P 500, you'd probably get a fair value that was too low. So, not surprised that a lot of models are suggesting the market's overvalued, but perhaps those valuation models are out of context, and that really is what creates the challenge across doing this in time series.
So you have the weight of these groups change. Mag 7 and tech is large because it's outperformed. So you can even get that and understand that that's going to play a larger role. But in those regressions and looking back, you're also looking at sectors and growth that changes over time. So you have change over time in terms of what percentage of the market is made up by these things, but also what those sectors represent. We talk
Yeah.
about the Mag 7 today. The last big acronym we were talking about was FAN. You're talking about 14, 15, 16. Still a lot of those same companies. Facebook, now it's Meta, but they're kind of, we're talking about a lot of these same kind of companies. Their earnings picture is so different. Those were super high. That was a super high multiple cohort. That cohort is leading the way in earnings. It was pushing multiples then. It's pushing earnings now.
So one of the interesting things that we've seen, because again, it's extremely difficult, and every year strategists kind of get a reset, and wherever the market ends the year, put a price target out, or what's the market, what percent is the market going to go up or go down. And one of the things that we've found that is quite interesting is that there's a clear reactivity function to where markets go and how estimates change. And we've found out that across really the history of strategist targets that we can find on Bloomberg goes back to roughly the early 2000s. And real simply, the consensus number just basically follows the market with about a 3-month lag. And Stephen, you did some analysis on this. Share it with us.
Yeah. So I was looking at price targets and, quarterly, and then I was looking at the market quarterly. The correlation between change in price targets and the forward quarter change in the market was half of what the correlation between change in price and strategist price targets and the previous quarter in the market. So yeah, worded differently, strategist price targets tend to be a reflection of what happened over the previous quarter.
So if we can invest in strategist targets, we'd be wealthy. because they're really easy to forecast, basically is what you're saying.
Yes. If that was a series you could buy, you just looked at what the market did over the last quarter.
Of course. Okay. So there's a clear, yeah. And we see that, to be fair, again, there's always these articles about strategists. We see that behavior sometime in fundamental analysis.
Behavioral tendencies play an enormous role in markets. It's not just strategists. We're definitely not trying to pick on strategists. You see in economic data, we're such a function of kind of what's happening today.
Yeah. So basically, what you're saying is that in a lot of the survey data, we look at whether it's forecasts of markets or stocks or economic data, a big component of what seems to drive those forecasts are what's happened in the recent past.
Absolutely.
So we stopped doing market targets.
Plot twist in this episode.
Yeah. And not because they're hard to do, but I guess we think there's more intentional ways to express investment recommendations rather than the binary S&P 500 target. Are you bullish? Are you bearish? And, in the end of the day, for our clients, which are institutional investors, we hear all the time, especially from hedge funds, I don't care what the market's going to do. And that's because they're often have a long short portfolio. They're market neutral and they're just trying to buy stocks that go up and short stocks that go down, or at least go up less than their long portfolio. And then you think about mutual fund managers, right? They have a mandate, and their mandate, of course, is to beat the market. So in a way, whether the market goes up or down is less relevant to whether or not their portfolios are doing better or worse. And coming out with a price target and using that to indicate whether you're bullish or bearish, while sometimes a really bullish estimate is consistent with a positioning in a portfolio in a real risk-on way, that's not always the case. And we've seen that the last couple of years where markets were up a lot. If you were to tell me the last 2 years, the markets were up 40, 50%, and looking throughout history, I would have said, you know what, small caps probably did really well, but they didn't.
That's a great point. I think most people don't. Given a 500 target, you're not given an FX target, you're not given a rate target, you're not given a 600 target, you're not giving a growth target you're not doing targets for all these things. If we're really just looking at the S&P 500, 20% last year, most people, without using what small caps are going to do, would have been like, oh, small caps are probably up 30%.
Yeah, and that was true in 2022 as well, right? The big caps really had the worst performance in 2022, which again is not consistent through history, but all of this goes to the declining relevance of price targets. So, that is why we stopped doing price targets back in the middle of 2024. And take a listen to this segment from this article that Bloomberg published regarding that change.
As I've documented before, strategist targets imply a false sense of precision and routinely lead investors astray. The average strategist in Bloomberg's survey often gets the direction of markets right, but not very much else. Not much of an accomplishment in a market that usually goes up. The average point estimate at the start of the year regularly misses the actual outcome by a wide margin. What's more, if you were to closely track changes in the consensus price target and actively trade off that, selling whenever the index rose above the target and buying when it fell below, history shows that you would reliably underperform a simple buy and hold strategy. Bottom-up price targets are also reliably unreliable. I don't blame the strategists for failing at an impossible task. I constantly learn from their nuanced work on sectors, styles, and market regimes, but I suspect that most of them know the index target task is bogus. The majority of them coalesce, knowingly or unknowingly, around safe estimates that defy the true range of potential outcomes. Kontrowitz has gone out on a limb with his calls and deserves credit for that.
Yeah, that was a great article by Jonathan Levin. So, Michael, as the strategist, why did we stop?
So I think the chart that really stood out to me, and everyone was talking about it in 2023 and 2024, focused on the Mag 7 carrying the index. But when you look mathematically, we reached the lowest correlations of stocks within the S&P 500 in at least, basically 20 years, as far back as we were able to grab that data. In other words, what the market was doing and was not correlating with what stocks were doing with the market, i.e. it was extremely narrow. And we felt that providing an index target which could be construed into a broader view, really wasn't no longer being reflected in the average stock. And again, we felt that providing much more intentional kind of going down a level, going into sectors, going to style, going into factors was really where we wanted to have our focus and our efforts. And it was essentially that the target was just distracting from that. And that was the case in 2024 once again, where we saw, where did we end the year in terms of the top biggest names? 38%, I think, the top largest names in the S&P 500 in terms of their weight. So this concentration of this narrow basket of stocks just continues to grow. And that gave us 2 years, 23 and 24, where fewer than 30% of stocks beat the index.
That's interesting that less than 30% of stocks beat the index 2 years in a row. And we all know that a lot of those stocks that did beat the index were enormous and had enormous weight in the index. So for a professional investor or anybody trying to be diversified and not have all your eggs in a basket and be super exposed to idiosyncratic forces, in many cases couldn't even own, enough of those names.
That's right. And we've also seen this be an issue for sectors, which is, again, another area of that strategists often do. We get asked at the beginning of the year, what sectors you overweight, what sectors you're underweight.
Talk about my favorite fun fact for markets, which is the difference between the GIC sectors and the sector ETFs.
Yeah, we've really focused and emphasized factors in terms of recommending where we thought investors should be overweight and underweight, given our macro and market outlook, because we've seen similar issues with sectors. Not only are some sectors so overly concentrated by one or two stocks, take the discretionary sector, Amazon and Tesla, are an enormous part of the consumer discretionary sector. So how do you say, well, I'm overweight discretionary? Well, you better love those two stocks.
That was a big problem a few years ago, where basically the discretionary sector was only up because of Amazon and everything else looked down. So if you were a stock picker and you were like, I like discretionary, and you could have been right and got discretionary right. But as a stock picker, there was really only one stock in there that mattered.
Yeah, absolutely. And that's, we see that in the tech sector where it's heavily tilted towards a few names. And then, there's the other issue that these GIC sector classifications aren't always, increasingly in today's world, really well-defined in terms of where companies should be. I think of some of these companies like Amazon, is that a tech company or consumer or retail, or is Uber, is that a tech company or a transportation company or a consumer services company? So, that's been a big issue.
Even in more mature sectors, industrials, they're super defensive. There's very cyclical names within it. Being in a sector doesn't make everything similar within it.
Yeah. So that's why all of this is why, our team tends to focus on fundamental attributes, because we believe and we observe that instead of trying to figure out which sectors are going to do well, given the market outlook or macro outlook, we focus on what are the fundamental attributes that investors are going to chase, given the macro market outlook, because there's a lot more consistency across that. Because you put a basket of high profitability stocks together, that's going to behave similarly to how it did throughout history, and we've seen that. Whereas the tech sector today, is extremely profitable, has super healthy balance sheets. And while the multiple is high, and the last time the multiples that were high in the tech sector was 2000, you look at the fundamentals, they're just completely different. And so it creates these really loose ways of communicating investment ideas because of that issue.
Michael, I know we're talking about price targets today and not sectors. Before we go, I can't not talk about tech last year and the XLK ETF. If you were a strategist, whether it is for institutional or individual investors, you could have recommended the tech sector. And if you're an investor, and whether institutional or individual, went out and bought XLK, what happened to you?
You underperformed you underperformed the tech sector of the market, and you underperformed the S&P 500.
That's insane.
By 15%.
15%. You see it on TV all the time. tech sector up enormous. The ETF that you would have bought representing the tech sector, XLK, underperformed the market.
Yeah, and perhaps that's not obviously true for all tech sector ETFs, but that is one of the largest tech sector ETFs. So, thus, more people were exposed to that in 2024 than any other one.
Just a ramification of the enormous kind of cap buildup you've seen in these indices.
All right, so we've talked a lot about how doing price targets is difficult because you're forecasting earnings and you're forecasting multiples in a market that's changing over time in terms of composition.
Also talked about how we don't do them. Oh, let me kick it to you, Michael. What do we do? Give people a little bit for you.
So, of course, we do present our views on the market, and we talk about what are the variables that we believe are influencing valuations and where we believe those variables will go throughout the year. And of course, when we look at earnings and think about earnings, we do the same. There's a whole bunch of data that work that we do to try to understand really not where earnings are going to end up the year, but essentially where is consensus today and where are consensus revisions likely to go? Are they going to get stronger and higher, or is consensus estimates too high given what we see in the macro world, and they're going to be revised lower, right? Because everything's really rates of change. And so our view this year is that market multiples have gone up for 2 years because we've priced out a lot of the fear around recession, inflation, and a tightening in central banks. And that's been, of course, good news for the prior 2 years. But when we came into the beginning of 2025, really investors weren't worried about a whole lot. And that's reflected in a really high PE and really tight credit spreads. So we think this year is going to be more likely to be a backdrop where PEs are very volatile, but ultimately end up fairly sideways, which suggests that market returns aren't going to have that big PE expansion propellant behind it. And it's going to be really a function of what earnings are going to do. And we're generally positive and constructive on the U.S. economy. And we think that there will be some modest improvement in earnings breadth, which hopefully can provide a modest improvement in market breadth. And we'll be updating our thoughts on all of this in the episodes ahead.
Well, thanks, Michael, for your thoughts on the outlook for P's and E's. So we do give opinions on the two components that fit into it, but we don't do the overall target.
Thanks for tuning in to today's episode of What's Next for Markets.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.